Hi, everyone. Joe Kehrig, managing broker of Coldwell Banker Real Estate in Danville. And this is your 2021 real estate projection. First, let's talk a little bit about how we got to where we're at. So, February, before the pandemic, February was the best February we had in 13 years. And the reason why is because historically low interest rates, which have only gotten lower since February, we've had set 14 different records on interest rates. Every time they go down, it sets another record. So interest rates were low there. There's a lack of homes for sale, not only in our area, but through the United States. And one of the reasons in the East Bay that there's such a lack of inventory, there's not a lot of new building going on. And with the low interest rates, people are getting set in their homes at 3% or sub 3%, and they're not going anyplace, and there's not a lot of inventory to go out there and buy. So you can put me any place in the United States and basically just look at the supply and the demand, and I can tell you where the market's going. Well, they say if you have less than 5 months supply of homes on the market, and that's like if the homes quit going on the market, how long would it take to burn off? Less than 5 months is considered a seller's market. And we literally have, in a lot of our markets, weeks supplies of homes. In other words, if the market in some areas like, Blackhawk and San Ramon and Dublin, there's like less than 20 homes on the market. It's nuts. So if homes quit coming on the market, we'd basically be out of homes within a couple of weeks. So again, we got here because then COVID hit. So we lost our spring market. But since June 1st, with the low interest rates and getting lower and lower, this has been our spring market for the past 6 months. And there's no end in sight because home prices keep going up. But remember, interest rates are going down. Now we'll see what happens, obviously as we go, down the line. People go, well, what do you think, Joe, for 2021 overall? Well, I think more of the same because we have such a low inventory and the interest rates are still low that it's going to be a hot mess if you're a buyer out there. Everything's selling for, in Danville or the upper end markets, things are selling on an average for $100,000 more than asking. That means if one sells at asking, one is selling $200,000, over asking. So what potentially can change that? Well, I think in the next 4 or 5 months, we're not going to see a lot of changes. It's going to be a tight market out there and definitely a real seller's market in most things. Now, obviously, upper end homes, $3-4 million, are still moving more than they ever have moved. But that obviously you're not getting multiple offers on that. The other end of the market that there's some great opportunity for is condo and townhouses. Those prices haven't risen for 3 years because, again, right now where people want more bedrooms, bigger yards, people are moving out of those homes, so the supply is keeping up and there's not a lot of demand for those homes. So that's a great market. You used to be able to buy 2 condo townhouses for a single family home. Now you can probably buy 3 for the price of the single family homes because single family homes have gone up so much. So as I'm telling people that if you're renting, you can literally buy a condo and townhouse and your payments will be far less with the low interest rates under 3%. Than what your rent is. So again, where do we see the market? Where do we see any relief on site if you're a potential buyer? Well, if you remember a month ago when they announced the vaccines would be out before the end of the year, the 10-year treasury ticked up and also the interest rates ticked up a little bit. Now they've since come back down, but obviously, hopefully by the end of spring, summer they're talking about, where the vaccine will be widespread out there, where people will be able to it'll be available to anybody who wants to take the vaccine. And at that point, if interest rates tick up, obviously that's going to make a huge difference. If you're talking about interest rates, close to 2.5% and they go up to 3 or a little bit over 3, that's a 25% increase. So you take $1.5 million home, and your payments, basically your interest rate goes up 20%, then that's going to affect a borrowing power of $300,000. So definitely the rates going up, which if the treasury goes up and there's good news on the vaccine, that could back the demand out a little bit. Now on the other side of the coin, Usually, when in a normal year, once we get the end of spring, because our busiest months are February, March, April, May, then as we get the beginning of summer, it's still busy, but we see more inventory. The market levels out a little bit. So if we get a combination of the vaccine being successful and widespread at the end of the spring and summer, which would bring interest rates up a little bit potentially, and then we see more inventory hit on the market, we might level out a little bit. But again, I still think it's going to be a seller's market all through 2021. So let's look at some graphs. There's two that I'm using. One is a lot of these were pulled from the National Association of Realtors, and one was pulled from Windermere Economics. So let's look at the first one. The average 30-year mortgage rate history and forecast, where you can see that basically right now the average is 2.83, as low as it's ever been. And most economists are thinking it's going to go up. And again, you go 2.83 to 3.08, in quarter four, that's not a lot. But when you're starting at 2.8, that is $100,000 or $200,000 difference in buying power because the interest rates are starting so low. So they're going up 15%, even though they don't look like they're going up much at all. So mortgage rates will not rise significantly. But again, that's maybe where we start to see the affordability and the demand going down a little bit. Now the next slide is Jerome Powell, who's the chair of the Federal Reserve. We've never seen anything like this, where he's basically saying we expect to maintain the current 0 to 0.25 target range for the federal funds rate through 2023. They've never committed out there 2 to 3 years. So they're basically saying that I do think interest rates will go up a little bit, but they're saying for the most part, they expect the recovery to take a little while. Now, I think that that's pretty optimistic. And he said that a couple months ago, so, before the vaccine was announced. So maybe he might be thinking a little bit different right now. So again, we talk about the 10-year treasury. Well, again, in quarter four, you can see it's 0.81. You can see where quarter three to quarter four, it jumped up a little bit. That's when the news on the vaccine came out, and they're expecting it to go up. And if you look at that, remember that follows the interest rate slide I showed you before, because interest rates follow the 10-year treasury, which hopefully might back off the demand a little bit, along with maybe more inventory. But look at U.S. existing home sales, the history and the forecast. Well, they forecast for 2020 there's going to be over 5.5 million, then close to 6 million, and a lot of people are saying, and remember, these are just existing home sales. When you put in new home sales, obviously it adds to this, but you can see they're expecting many more sales. Now, through most of the past 6 months, when the market's been nuts, even though it's been a seller's market, it has backfilled. So we've had a lot of pendings, but then homes have been coming on the market, so there's been a lot of sales. Right now, the sales are going down because there's not a lot of inventory on the market. So hopefully that will change a little bit. So you can see the median price, sale price of existing homes in the forecast. You can see the U.S. annual change, and obviously huge in 2020, and they're still expecting inflationary appreciation, 4 to 5%. They will rise at a slower rate because, again, as prices went up, the interest rates were going down. Well, as interest rates stop going down, it's like a rubber band. You can only stretch, so far as the affordability becomes tougher and tougher as interest rates go up a little bit. So that's why they're not expecting as much. Now, this is nationwide. In our area, obviously, prices have gone up 20%, in the single-family home market. Condo townhouses, not so much, but single-family homes have probably gone up 20% in the most desirable areas that have the backyards, have a lot of bedrooms. So single-family new home sales, you look at the forecast. And the reason that's going up, because one of the issues with 2005, 6, or 7, because of regulations, the builders were not building a lot of new homes. Well, now the builders have, especially with Jerome Powell coming out and saying, hey, he expects interest rates to be for 2 to 3 years, the builders have really ramped up. So where the builders, where we're like 2 to 3 million homes short, the builders were only building 1 million a year. Now they've pumped that up. So you can see that basically this is in thousands. So they expect 1 million new home sales this year. Before, as you see, going down all the way back to 2012, it was less than 400,000. So, and that's because we finally have some new homes to sell nationwide. Not as much, in the San Ramon Valley, East Bay, but still a few neighborhoods here and there. So again, Lawrence Yun, the chief economist for the National Association of Realtors, say Q3 and 4 home sales 20% higher than 2019. So the actual sales, the number of sales has been 20% higher. Home sales 3 to 5% higher on an annual basis, and remember, we lost 3 months of the year as far as sales. Home prices 7 to 9% higher than 2019. Obviously, in our area for single-family homes, it's more than that. And low inventory is a big constraint, even further gains in home sales, because that's what's going to happen. We've been backfilling with property, even though it's been a seller's market. Now that backfilling has stopped. So we'll really see what happens at the beginning of the year if a lot of potential sellers try to take advantage of the market and get more inventory up there. Now, the unemployment rate was projected to be 9.6% in December, and they revised the number to 6.9%. By year end 2021, they project 5.5%, and by year end 2022, 4%. Remember, a lot of people thought the market was going to tank because of the high unemployment because of what happened to COVID. Unfortunately, we've talked on previous videos, the issue with that, over 60% were service workers, restaurants, hotels. And with our average price of a single-family home being over $1 million, unfortunately, those in most cases are not the buyers for our home. They're basically, white-collar, high-level executives that can afford $1.5 million home. So the unemployment, being highly trending towards service workers did not affect us that much here. But plus, even saying that, you can see it's going down and down and down, and they expect, by year end 2022, and by 2021, they expect it to be less than 6%, which you get to a point where it's they count when you're around 6% as full employment. Anybody who wants to work is working. So again, the unemployment isn't going to be a factor. The foreclosures aren't going to be a factor because, as I talked about, the forbearance in another video, that 42% of the people out there own their home free and clear. And a large majority, 91% or around 90%, people have at least 10% equity. So people aren't going to just let their homes foreclose. Plus, the banks learned from the last real estate recession. They don't want the homes back. So they're going to work with people. And if people really have to sell or, are really up against it, they can sell their home and get equity out of their home. But the unemployment and foreclosures are not going to be a factor. Why is it happening? Why are we seeing in the, especially in the East Bay? Well, remember the old saying, go west, young man, go west? Well, now it's go east, young man, go east. So we're seeing people from the urban in the peninsula coming over to our area, and the people that we see moving are saying, hey, I'm going to sell my home where the prices are the highest, and I'm going to Idaho, Nevada, Utah, Oregon, Texas, and moving out of the state for a number of reasons. But, one of the things, like we talk about remote workers on the move, between 14 and 23 million plan to relocate due to now they can work remotely. Most of the companies have gone out there and said, hey, you're working remotely in all of 2021. And that's where you're going to see the shift. Now, people will still go back to work because there's a lot of jobs where, especially engineers and such forth, where there's a lot of collaborative stuff that goes on. But for the most part, I think that there'll be a lot of people that will stay working remote, and a lot of people might go in for, 2 to 3 days a week. But definitely it gives them the opportunity to move a little bit further away from work. So over 20% of those planning to move are currently based in a major city. And 54% of people relocating are moving more than 2 hours away from their current location. Because again, if they only have to go in, commute a couple days a week. We've seen that a lot with our service, the fire, police, especially firemen that basically are working in Palo Alto and Stanford and the Peninsula and Menlo Park, how do you afford a home on basically on a fireman's salary? Well, you know what? They live more than 2 hours away because they work 4 on and 4 off, so they only have to commute a couple days of the week. So I think that's what we're going to be seeing now with white collar workers. So Realtor.com said big homes have fallen out of favor. Then came the COVID pandemic, where everyone wanted kind of smaller, but now everyone wants that fourth bedroom, that Zoom room, that at-home school, the yard for the kids to play, especially after we experience more and more lockdowns. In-office work from home combo. People are moving 1.5 hours from their workplace. Lower taxes, less regulations, cold to warm weather. People are moving also. You see a lot from New York to Florida. And a lot of people are moving out of California just politically, because of the lower taxes. You got Texas and Nevada with no state income tax, less regulations. I mean, now just recently, Oracle announced, huge company moving out. HP announced they're moving out. Tesla's moving out of California. Now, people ask, is that going to have an effect? Not short term, because there's such a lack of supply on the market. And a lot of those people will choose to stay here and they can work remotely. But a lot of them will leave, and you will see more homes go on the market. But right now, those will get absorbed. But there's no doubt that the exodus from California, especially from these corporations, are going to have a long-term effect on California and the inventory and the prices. And that's, the values and ideology. Obviously, California is, for the most part, a Democratic state, left-leaning, from the governor and, our senators and the House of Representatives. So there's a lot of small counties, as you know. I think in California, the Republicans picked up five districts, for the House of Representatives. But for the most part, it's a Democratic. They have a supermajority. So it's definitely people are leaving to some more conservative states. So that's another reason why they're doing. The pandemic is making people reconsider city living, trading traffic for chickens. So we don't quite have chickens here. But so anyway, overall, it's going to be more of the same. It's going to be a seller's market all year, though let's hope, for a number of reasons, that the vaccine is successful. It gets widely spread out there, and then you'll see the 10-year treasury go up, with interest rates will go up a little bit, and then if they go up a little bit, it will back off the demand a little bit. Then hopefully people taking advantage of this market after the springtime, selling their homes, more homes come on the market. So I think right now, where it's so out of whack, hopefully the end of spring, summer, a little bit more inventory, a little less demand might even out the market a little bit. But expect, for the most part, to be a seller's market all year. So again, if you have any questions at all, reach out to me. Everyone's situation's a little bit different, with obviously a change in power from Democratic to a Republican to Democratic president. There's some tax laws out there that will change. 1031 exchanges. There's been proposed some changes, stepped up tax basis. Obviously, first-time home buyer programs on the positive side. So if you have any individual questions, because again, this is like a chessboard, and so take advantage of my 43 years of professionally selling, including through the last 5 recessions, which we're not expecting at least a real estate recession anytime soon. Because remember, 4 of the last 5 recessions, except for the last one, real estate prices actually went up, during the recession. But if you have any questions about your individual situation, please reach out. My cell number, 925-487-6838, or joe.kehrig@cbrealty.com. Again, I'm the managing broker of Coldwell Banker Real Estate in Danville. And if you like these videos, please tap the like button and hit the subscribe button, and then click on the bell to receive alerts on new videos. So best wishes to you in 2021. May God bless you, God bless your family, and may God bless the United States of America.